Bajaj Auto trades in the green after the company beat street expectations in the third quarter earnings. Management tells CNBC-TV18 they look to maintain overall margin and exports above 20%.
TVS Motor also up in early trade on the back of a steady set of Q3 earnings. Management in their Q3 conference call says that their focus remains on premiumization and product mix. UBS has a buy call on the stock, while JP Morgan has an overweight call on the stock.
JSW Energy slips more than 5% on the back of muted third quarter. Revenue declines 5.5% from a year ago. Margin too contracts year on year.
Bosch comes under pressure and is more than 4% low after reporting all-round miss in the third quarter. The net profit declines by 12% from a year ago. The margins to contract on a year-on-year basis. UBS issues a sell call on the stock.
And in more earnings reactions, we have Sirma SGS, Ami Organics and Latravenues Tech, or better known as Ixigo, rally on the back of their quarterly numbers.
Hello and welcome to Chartbusters. I'm Nigel. With me is Mangalam, and as you can see to the top of the screen, all the indices are in the green, so that's good news. The Nifty Bank as well, that was relatively underperforming, seems to be getting its act together, but your portfolio is feeling good because of the breadth of the market. You have 10 stocks that are advancing for one stock that's declining. Been a while, Mangalam, since we saw this sort of market breadth. The first 2 hours have been good. Let's see how we can end this day.
If we sustain above the 23,150 mark for a while, then maybe we'll see some more short covering given there is expiry tomorrow. The good part is mid-caps outperforming always gives the sense that maybe there is support at lower levels for the market itself as well. But a lot of stocks on our radar. DLF is the one that has reported strong numbers in the third quarter, marking its best ever quarter in terms of new sales bookings. Ashok Kumar Tyagi, who's the managing director of the company, joins in now to discuss the quarter that went by. The stock's doing well at the high point of trade. Mr. Tyagi, it was a good set, and we had an inkling of that because of the response that you got to the Dahlias itself. The question is that at the 9-month mark, you've crossed your entire guidance for the year for pre-sales. So if you could give us a sense of what your new target for FY25 pre-sales is, and at the same time, if you could give us a sense into what you're expecting in FY26 with the balance of products left for you to sell.
Okay. So good morning, Mangalam and Nigel. We had guided the market for a sales of about 17,000 crores, as you're right. And as the numbers show, we have exceeded that in the 9 months. I mean, clearly, this is a great position to be in. We have, as we mentioned in our analyst call also on I think Monday, we have right now 3 projects which are underway from an approval cycle standpoint, which is the Mumbai project, the next round of Privana and Goa. And frankly, this is a business which sort of, it's reported quarter on quarter, it's not run quarter on quarter. And I think depending on how the approval cycle happens, we'll see the launch in Q4, if at all. We are currently continue to be optimistic on Mumbai that if we can get all the approvals in, we should be able to launch it before March end. But again, if it sort of overshoots by a couple of weeks, I don't think we are losing any sleep on that. So I think we'll clearly exceed 19. What the final numbers are, I think let's just wait for the year to end. And as far as the guidance for the next year is concerned, Mangalam, we have the products lined up for sort of launch in the medium term, including the fact that Dahlias itself has almost a 23,000 crores, sales potential still left. So I think we would have a healthy 25-26 as well. But again, as has been our convention, we typically announce the guidance for the fiscal when we report the annual numbers in May.
All right. Hi, Mr. Tyagi, and good to see you. When just looking at this project that you were talking about, the Dahlias project, I believe the average ticket out there is 70 crores, a massive one out there. Give us a sense on demand. There's that fear that urban demand suddenly is slowing down. But if you're selling some of these projects, then clearly you're not experiencing that. But give us an update. How do you see things shaping up?
Okay. So firstly, of course, Nigel, I'm always a trifle scared of you because of your extremely strong grip on numbers. मुझे डर लगता है आपसे बात करते हुए, but
that's the numbers is all we can hold on to. But these 70 crore projects and all are something that make us a little bit nervous and tell us there's lots more to achieve in life. Give us your sense on urban demand.
So here's the deal. Yes, it is correct that the average selling price that we have achieved in the first 171 apartments we have sold is about 64,000 rupees a square foot, which does tend to be almost a 70 crores as the ticket size because most residences are between 9,500 square feet, plus. Now, a large part of this phase one of the launch has actually been lapped up by the existing customers of Aralias, Magnolias, and Camellias. And there has been, I think, about a 10 to 12% chip in by the NRIs as well. So clearly, while the story of the slight moderation in the urban demand may be true from a holistic standpoint, I guess in the luxury and super luxury segments, the demand and the hunger for the quality lifestyle continues. In fact, not only here, we see that trend also in our luxury malls on a completely different perspective. But I think clearly the luxury and the super luxury segments continue to do very, very well, at least in the markets that we operate in, Nigel.
All right. You've given us a sense of pre-sales. You've given us a sense of the launch pipeline as well, and the outlook going forward here. What the street also wants to know is a word on collections. What are your target collections for this year? By the end of this year, what will be your operating cash flow that will come into the company? And to that extent, what's the proportion that one should work with in the next year as well?
So this year, this quarter, we reported an operating cash flow of 1,800 crores. I think across the 3 quarters, we are now at about 4,800 or 4,900 crores. So clearly, we will continue to hopefully collect at this clip of 3,000 odd crores a quarter, and which will translate into an OCF of somewhere between 1,500 to 1,800 crores of operating cash flow. And I think those are the metrics that we should continue running at. In fact, while obviously there's been a lot of I'd say positive vibes on the pre-sales number, the fact is what we truly focus, Mangalam, and pride ourselves on is the focus that we do on 2 metrics. One is the new embedded margin that we are creating, and one is the operating cash flow. And in this quarter, we added almost 8,000 crores in the margins column and almost 1,800 crores on the cash flow column. So clearly, I think operating cash flow continues to be very strong, and also a very strong focus area for us. The only tone of moderation, I'd say, is that given the construct of the RERA regime, a large part of the cash flow does get entrapped in the 70% escrow accounts, which obviously is used for construction, but the margin, but the surpluses take some time before they're finally released.
All right, we're just going to wrap up, Mr. Tyagi, but I've got a number on the screen. The rental revenue was around 1,200 crores, which was up 10% on a year-on-year basis. What's the target out here? Very quickly.
So we are targeting exiting the March 25 with a run rate of 5,000 crores and exiting March 26 with a run rate of 6,000 crores on Cyber City, and almost 1,000 crores exit run rate in 26 for the DLF segment of the Rentco. So overall Rentco should be about 7,000 crores exiting March 26.
Is there any plan of you unlocking value out here? Because there's an annuity of close to 5,000 to 6,000 odd crores every year, right? So, if you do that, then if you do the reverse calculation, it could be a massive value generator for you. Is there a plan here?
No, it will be a massive value generator. Currently, Mangalam, we are in the process of building out significant build-outs in the rental business. I think a total of about 15 million square feet is under active planning or execution of the capex build-out. So I think really once that cycle is completed, at that time maybe GIC and us will have a chat on this. But in the immediate short term, there are no plans for monetization.
All right, we'll keep an eye out on that one. Thank you so much for joining in and giving us an outlook for all parts of your business. Wish you good luck and hopefully speak to you after the budget as well. Post announcements coming in from the finance minister, you give us a sense of there being some strong demand in the premium end of the market, but not so much in the middle and affordable. And could that change as well or not is a question that we'll get an answer to post this budget. Thank you so much for joining in. With that, let's get you some ideas for profit coming in from our colleagues at Money Control Pro. Sachin Pal joins in today.
The stock in focus is Cyient DLM, which is a leading player in the electronic manufacturing services space. The company recently came up with its Q3 numbers, and the top line growth of the company was fairly strong at around 38% year on year. This was primarily driven with the acquisition which the company undertook last quarter, and that really had a positive impact on the overall top line growth. Adjusting for the acquisition of Altech Electronics, which the company had recently concluded, the overall revenue growth for the quarter came in at around 11% on a like-for-like basis. The key disappointment for the business, however, came out on the margins front, where the margin profile of the company was impacted by some M&A costs related to the acquisition, as well as some higher employee costs and some seasonal factors. That being said, the company continues to improve its cost structure and enhance the scale, and is hopeful of moving towards a margin trajectory of almost 10% over the medium-term basis. On the top line as well, the company is targeting a top line growth of almost 30% from a medium-term standpoint. The order inflows of the company has also weakened in the recent past as it's facing some challenges in terms of new inflows from the industrial as well as medtech sectors. So therefore, the overall demand trends of the company continues to remain muted. That being said, the company has added 4 to 5 new clientele in the first 9 months of FY25. So that should heavily have a positive impact in terms of new order wins going into the next 12 to 18 months. Well, the stock has taken cognizance of disappointment and the mixed trends that the company has displayed in Q3 FY25, and it currently trades at around 38 times FY26 estimated earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
Thanks a lot for that, Sachin. For the time being, we'll slip into a short break. On the other side, we'll be joined by the management of GE Shipping. Mr. Shiv Kumar is waiting for us. Welcome back. Let's focus on GE Shipping. We have with us Mr. G. Shiv Kumar, who is the Executive Director and CFO of the company. Hi, Mr. Shiv Kumar. Always good to speak to you. Thanks a lot for joining in. Well, the last quarter was marked by a couple of factors like the Red Sea troubles, the OPEC plus curbs as well. Could you give us a sense about how rates are panning out? If you could tell us for this quarter, what are rates looking like? And if you compare it with, say, last year, how are things looking? And even the previous quarter, a broad sense, category-wise, about the rates.
Good morning, Nigel, and thanks for having me. Always a pleasure to be here. The winter, to give you the headline news first, so winter has been disappointing for the tanker business. Typically, we have a very strong period through the Northern Hemisphere winter. The winter has been disappointing.
Right.
So if you just look at what's happening with tanker rates today and this quarter versus last year, the large tankers, that is 100,000 tons capacity and higher, typically these are crude tankers, are probably averaging about $25,000 to $30,000 a day versus about $45,000 to $50,000 a day, same time last year. And versus the previous quarter, that is October to December, they're about the same. The smaller tankers, which are the product tankers, which are around 50,000 tons carrying capacity, are making about $20,000 a day on average versus probably $35,000 a day in the corresponding quarter and around the same rates in the previous quarter. So it's last year we had a strong winter. This time we do not have a strong winter season for tankers. Bulk carriers are also significantly lower than they were a year ago. On average, probably $5,000 a day lower in earnings.
What does that do to your operational performance then? You know, Mr. Shivakumar, we often ask you the freight rates, and then the corresponding question to that is your break-even rates for all of these. How far above these break-even are you, or in what categories are you below break-even right now because of these rates?
Yeah. In tankers, we are above break-even in all the sectors. Whether it's a small tankers or the large tankers, typically the break-evens are $10,000 to $15,000 a day. So we are well above those numbers, except that the profitability has come down. It's just a reduction in the returns in the profitability. In bulk carriers, we are in the smaller bulk carriers, we are below break-even at current spot rate. So typically across the board, whether it's a 57,000, 58,000 ton bulk carrier or 180,000 ton Cape-size bulk carrier, rates are between $6,000 and $8,000 a day. And this is just around operating costs. So you're not even recovering depreciation at current spot rates. But tankers continue to be profitable even at subdued spot rates. And of course, we have some ships on time charter.
And what is your prognosis on rates going forward? It's been a disappointing winter. Red Sea crisis has been there, but a lot of people are hoping for a brighter summer. Just trying to understand, where do you see rates headed from here? Do you see them going lower, or maybe they've bottomed out?
So the biggest factor, Mangalam, is going to be on geopolitics. And we've seen in the last 2 weeks or so, a new round of sanctions on Russia-linked ships. And that's covered about 150 plus tankers, 150-ish tankers, which is about 2 to 3% of the fleet. And if those ships are not able to trade, then that immediately removes supply from the market. So that's one big factor which can come in. If sanctions on these ships, this is the so-called dark fleet, which is carrying out the sanctioned trade. If that goes, then that's an automatic reduction in the supply of ships. So that's one big factor. And obviously, the US administration is now tightening the sanctions on Russia and related trades. We've seen one port group in China, which is the Shandong port group, rumored to have said that they will not accept sanctioned tankers anymore, sanctioned vessels anymore. And that port controls more than 1 million barrels per day in imports of oil. So again, if sanctioned ships are not able to trade, then that removes them from the market. On the other side, you could say that oil goes out of the market. So finally, it is if oil demand stays reasonably strong, supply goes out of the market because some ships are just not able to trade. And we look back at what happens when the US sanctions ships. The last round of sanctions was in November 23, when about 30 or 35 ships were sanctioned. After that, they've hardly traded at all. So they just effectively get taken out of the fleet. So then that's a reduction in the supply. So all of this is sort of up in the air because there are so many of these factors which can affect the way freight rates can play out.
All right. Your NAV has dropped despite having a good EPS, cash EPS in the past quarter. Do you expect ship prices to go down further?
They have gone down already. So they've gone down about 15% on average, slightly more for the older tankers, which had gone up a lot in value, maybe 20%. So they have gone down. So we are still waiting for the opportunities. Dry bulk have also gone down a little bit. And obviously, because of dry bulk earnings not having been very strong, unlike tankers, they are closer to where we may think of investing. So we are getting closer, but not quite there at the point of investment, where we would say that let's go out and put in a big amount of capex.
So it's corrected by 15%. You're still evaluating. So how much more does it have to fall for you all to be interested?
I'm not going to get into those numbers, but it has to have a substantial fall in tanker prices for us to really think this is the time to go, not all in, but very significantly into the market.
Right. As they say in the markets, it's a no-trade zone right now. Not too high for you to sell any of your assets and not too low for you to, perhaps buy any of those assets. So we'll keep an eye out on that trend as it, continues. But the final question, and we always ask you about, renegotiation of rents in your offshore business. What is coming up next, and what is the likely sustainable EBIT in that business quarterly going to be?
Yeah. So we have 2 rigs which are up for repricing now, which need to find employment, where we've bid them into 2 tenders, but we don't know what will be the outcome, whether we will win those contracts, and if we do, at what price. So it's tough to give a prognosis because we haven't had a pricing for the last year or so in this market. So it's tough to give a prognosis on what could happen to those rigs. What has happened in the vessels business is that the vessels business has been doing pretty strongly. It's come back to quite solid profitability, where all the contracts, every new contract that we've entered into has been higher than the previous contract. So the vessels business has been doing pretty good profitability. The rigs business, because the rigs haven't got contracts, that's something that still up in the air. And we don't know what can happen there.
All right, Mr. Shivakumar, we'll leave you on this uncertain note, but leave you with a promise to join us as soon as you have any updates on freight rates, if you're buying any ship, if you're selling anyone, or there are any of those sanctions that you spoke about. any geopolitical issue that comes by that impacts your business as well. And at the same time, when you reprice those contracts, we leave you with a promise to join us and tell us exactly how it will impact your business, whether positively or not. Thank you so much for joining in. Wish you good luck for the quarter ahead. Take a short break, come back, get you more on the markets and stock-specific action.
Welcome back. Well, there is a couple of stocks in the broader markets that are calling for our attention. So on the upside, Sirma is a stock that was down, I think, 30% for this year to date. Well, it's decided to pull things back, and now it's up close to 20%, locked in upper circuit. So big bounce back is what we're seeing. And on the flip side, Mahanagar Gas, the stock that was up close to around 3%, I recall at the start of this hour, that's done a complete U-turn, and now it's down. It's moved into the red, so it's given up close to around 5% from the high point of the day. That said, all the frontline indices, they continue to trade in the green. We'll wrap up on this edition of Chartbusters with news that the broader markets are doing well, so your portfolio will be feeling a lot better. Trading Hour comes up next and take all the action forward.